Let me welcome back to the show Paul Beattie, one of the co-founders of Beattie Global Fund. By the way, I'll add this, is Beattie Global Fund has had a terrific track records over the years, up about 9.5% last year, about double what you were making on the TSX. Paul joins me now on the line. Paul, thanks for finding time for us. And I'm just wondering, this must be a harried time. I mean, you've got so much, in my opinion, central bank manipulation. You've got geopolitical events taking place like the Brexit vote. I mean, this must be a tough environment to be making investments in.
Yeah. Hi, Mike. Good. Thanks for having me on the show. Yeah, it's we're finding it anyway quite a challenging time. But it's also a frustrating time. But the thing that frustrates us most is the missed opportunities. I mean, it's complicated to invest and lots of dangers out there. On the other hand, there are opportunities everywhere. And, just this year alone, the number of stocks, that we've missed that have gone up, considerably is amazing, right? So you got to pick the right sector, and you can do very well.
And I think that's the key, though, isn't it? If you're playing the broad market, I mean, they haven't done much. You're playing in the right individual sector, or you're staying too long in a sector. I mean, there's your risk reward there. I mean, it's very specific in that way.
Absolutely, that's the key. What sector do you want to play? I mean, if you were in the golds at Christmas, I mean, how much have you made this year? It's phenomenal, and the silver stocks are phenomenal, and of course, oil's recovered quite a bit.
But when you look at something like that, Paul, do you feel like it's too late in the game to get into a sector that's grown? Like it seemed to me that the stocks got way ahead of the individual commodity prices. That we had the move in oil, which was obviously significant, but the stocks looked even happier, maybe more so in gold. That you see, 100% move upward in many gold stocks, and obviously the metal hasn't doubled.
No, right. Yeah, I think when it comes to the gold stocks, I mean, so many have moved. Basically, all the large cap and let's call it mid cap. Companies over 500 million, they've moved tremendously. So, but is it over? I think they need gold to go up from here for those stocks to appreciate. And so we've sold all our larger cap and even the mid cap. What we've done though is we've gone down to the cash flowing smaller cap, so $200 million companies that are in production with cash flow, and I think they're terrific value right here. They don't need the gold price to go up for these stocks to double. So we've got a few of them.
Yeah, actually, you mentioned something that I love about the way that at BT Global approaches the market. You have a big focus on cash flow, and I want you just to go a little further and explain that to us, because I think that's a valuable tool. Just to explain to some novice investors who'll be listening today and some people with more experience, why do you look at cash flow as such an important factor in your decisions? Well,
one of the reasons, of course, is we're finance guys, and we're not gold mining experts by any means. So, but the thing is, we can measure the value of a company and a gold company as well as a utility or anything else. Based on the enterprise value to EBITDA ratio. Mm-hmm. Now, most people in the gold space will tell you not to do this and spend all your time looking at reserves and more complicated geological issues. But we focus on enterprise value, so the market cap of the company, shares times the price equals the market cap. Add on the debt. Often don't take off the cash because, of course, mining companies are going to spend it or invest it. And so you get to enterprise value, and what is the EBITDA? What's the cash flow from the mine or mines? And therefore, what's the ratio? And, it's hard to believe. I think, as we've talked about, the Canadian market is quite inefficient, we believe. And we've got, after this good gold run, there's still a bunch of Canadian companies, listed gold companies, that trade at sub 4 times enterprise value to EBITDA multiples. And whereas the market's moved up to 8 to 10, and the big guys are trading at 15 times.
Mm-hmm. Well, when I look at cash flows as an analytical tool, has that become even more important really since the credit crisis? Because, one of the things that did in so many companies in the immediate aftermath of the credit crisis is they couldn't access the borrowing markets. They were just out of luck with that, and hence they went down. So it seems to me that having a company that can sort of stay afloat, why? Because it's taken in more money than it's sending out. That's got to be a key, I would think. Even now, with such easy money, you hear lots of stories where banks are reluctant to lend. So I would think that's even a more important factor to consider when making an investment.
I mean, if you have very little debt or no debt, and you're trading at 4 times the cash flow you generate, like, how risky is that for an investor? Mm-hmm. I mean, you're not going bankrupt under any scenario, really.
Yeah.
So, I think it's the key parameter. I've had this debate with many mining experts and mining expert investors, and they keep telling me it doesn't matter. But to us, it's all that counts.
Yeah. Well, I mean, if you're not in business later, as you say, I mean, let's face it, this is a debt-consumed world, whether you're talking at the global level, the sovereign debt crisis, or whether you're talking at the corporate level, and we certainly saw that in the aftermath of both the credit crisis, and seems like it's rearing its head again. I wouldn't want to be in a UK property fund right now. I'm not suggesting they're going to go bankrupt, but they've certainly eliminated withdrawals at this point. I mean, there's lots of examples of where debt is overwhelming, and I look at emerging markets. So, I that's why I would emphasize this kind of a figure: is what's the probability that this company is going to face a disruption if the credit markets freeze up? And that, to me, this is the number one criteria to look at in an individual company. But as I say, especially in this environment, for me.
Yeah, I know. I think so. I mean, you take a look at the Canadian oil patch. The guys that are levered, 6-7 times cash flow. The problem may not be with the company. They would, under normal circumstances, perhaps get through it. But the banks come in and say, "Listen, we're overexposed to energy, so we need to cut back." And then you're done. It's over. So low debt levels and low cash flow multiples, I think, is the way to. These are not, especially in a low interest rate environment, these are not risky investments. Mm-hmm. I mean, you can buy any company at 3 times cash flow with very little debt. I think almost any industry, this is what you want.
One of the things that's a feature of this market, though, is that, like, for example, in BT Global, you've done well in some, obviously you choose stock specific after you've looked at the macro view, and the industry view, and then you go into the stock. But I still can't get over the level of volatility that, let's say the tech sector, which you've had some big winners in, but man, when it turns sharply. And I'm just wondering how you protect yourself against that. When you enter a stock, do you already have your sort of sell parameter in mind, or are you looking for various things to line up and you say, no, I'm out of there?
Well, we run a hedged strategy. So what we'd like to do is, we pick our longs within a sector we've decided to get into. Then we spend most of our time trying to figure out who's expensive in the sector and try to short some of that, against our long positions. We don't do it, exactly, right? 100. If you invest $1, we don't short $1. But, you invest $1, you short maybe 50 cents of a more expensive stock. And then if the sector turns down, as you say, it happens quickly and affects everybody, then you get a chance to add to your short and lighten up in your longs, and you can actually make money on the downside.
I'm talking to Paul Beattie, co-founder of BT Global. I'll get back. I got to take a break, so I'm going to come back. I'm going to ask Paul really what is he can give us some specifics. So pick out the sector, walk us through the methodology that's resulted in another 5-star rating for BT Global. We'll do that in just a couple of moments right on the Money Talks Network. I'm very pleased to have with me Paul Beattie, co-founder of BT Global Growth, 5-star fund, terrific returns. Paul, I want to start with, there's so many things to get to, but if you allow me, let me just start with your view generally, or you can be specific, on the bond market.
Well, we don't invest in many bonds. I haven't for years. Negative interest rates to me it's the biggest shock I've ever seen. I mean, if somebody were to tell me, gold could go to $5,000, everybody thinks that's shocking. Well, how about negative interest rates? That is 5 times more shocking than oil going to 120 or gold going to 5,000. Yeah. So bonds, look, it's been a 30-year bull market in bonds. I think it's coming to an end soon. And when it comes to government bonds, I mean, just take a Government of Canada bond, or you're getting no return, and the government takes back half your half your interest anyway in taxes. So we're not there. I think there's way more risk than people understand.
Well, I think the other side of that is that, of course, it's pushed a ton of money into the equity markets. It's and of course the central bankers know darn well what they're doing when they do that kind of stuff. Also, other asset classes, you see it in collectibles. We've certainly experienced it in real estate for that and other reasons in all of Canada, but principally in Greater Vancouver and neighborhoods in Toronto, with the exception, obviously, of Calgary, Edmonton, because of the oil woes there. But what about this? I think one of the themes is we lose confidence in government, lose confidence in bonds. We don't trust them, like they don't trust Greek bonds, that's for sure. That's why you've had so much intervention by central. I still think that's positive for equities. I think that bond market money's got to go somewhere at some point, and I think equity is going to be the number one choice.
Absolutely. I mean, the thing also to keep in mind is that the bond market absolutely dwarfs the stock market.
Yeah.
Right? The size of it is just quantumly larger. So, you don't need 30% of the bond market to go into equities. All you need is 10%, and equities are heading dramatically higher. And I think
that's such a key point. Sorry, Paul, but I really want people to understand that is that the bond market is astronomically bigger than the stock markets. So all you'd need is some shift of capital, some major fund saying, you know what, I'm going to reallocate. I'm not too comfortable with the bonds. Let's move 10% of our money into stocks. I mean, that's a skyrocketing bull market there.
That's right. I think that's one of the risks that we face and we're concerned about is that, in fact, we could have a ripping stock market. I'm talking about the U.S., the S&P. It could rocket up on basically that simple issue. People reallocating.
I think that's what I'm in that camp who thinks that's what's about to happen. Can you walk us through maybe right now what you guys are seeing in terms of industries you like and maybe a couple of stocks you like within that framework?
Sure. We spend most of our time trying to figure out what's going to happen in the energy patch because we've come to the conclusion that if you can figure out where energy is going, where is oil going, you'll figure out where about everything else in Canada is going to go, including, of course, the currency. And I wish I had an answer for you, you and your audience, but I really don't. All I'm saying is we're spending all our time trying to figure that one out. We do believe you should own some silver. I think one of the safest bets out there is simply own silver or buy the SLV. There's every time gold goes up 10%, silver's going up 15, 20. It's sort of just gotten started. It's been 5 years since the last run, and I think there's a very good chance you don't need to buy the silver stocks. You just buy silver. We do like gold. We very much like 3 or 4 stocks. I can name a couple that in the gold space trading at sub 4 times cash flow. I mean, I think these things are easily going. Well, they're going one direction. They're going up. What else are we doing? We are Birchcliff has been a terrific. They did a transformational acquisition the other day, and mostly gas or gas liquids, and it's been terrific. The stock is going up seriously every single day, and we kind of like that. Larger cap, and Seymour Schulich's a big investor, and obviously the street loves the deal. So certain oil stocks, real estate stocks. We go into some of the smaller cap stocks, but I mean there's terrific value. Terra Firma is one of our favorites. Maybe. I don't know about the large cap REITs, but sort of the mid cap REITs and smaller cap REITs, I think are good value. Tech space, we don't. I don't think there's any good news in large cap tech land, and we'll see with the earnings of IBM and stuff. I think these big guys are struggling. Cell phones, which has been a big driver, it's definitely peaked worldwide, right? We're going to have, in fact, no growth, decline in cell phone, which means decline in chips. Computers are struggling. So the whole tech hardware space, I think, it's going to be challenging, and the valuations are stretched. So we don't like it, and we're shorting them. We're looking at highly levered companies, just as we talked about. I mean, I'm worried about Valiant and Concordia. Healthcare in Canada, right? This Concordia stock's been a huge winner for us and everybody else, but now it's going the other way. Now they have too much debt, and the multiple's very high. The price-earnings ratio is very low, but the multiple of cash flow, the EV to cash flow, is extremely high. We're very concerned about these guys. Governments are going to cut. They're not going to pay They want to cut the drug prices. They can't afford to pay these high drug prices, right? Mm-hmm. So I think that's going to be a tough sector.
Let me come back to the gold sector. Can you give us a couple of examples of the ones that you think are positive, like one or two examples of positive cash flow?
Sure. I mean, there's a Vancouver-based company, Red Eagle. I think that's our favorite gold name by far. We went to actually got in a plane and flew down. They have one operation. It's in Colombia, so it sounds risky. I know, building a mine in Colombia. Okay, but we went down, took a look at it. The mine's built. Okay, they're starting in September 15th. I think they're planning on turning it on and producing gold. It takes 2.5 days for the process to work. So it comes out of the mine, and 2.5 days later, they turn it into gold doré. So we're going to find out in September if this thing works. And I'm telling you, it's a very impressive operation. Very impressive people. Bob Bell is in charge, and if you do the math, they're going to produce 70,000 ounces. So it's a good size, but not a big mine. It's definitely not a complicated process. The insiders own a ton of stock. The guys that built the mine, the engineering companies and whatnot, own a ton of stock. Finance companies that finance it bought a ton of stock. So it's basically 60% owned by people that know exactly what they're up to. And, you do the math. And by the way, nobody on Bay Street's done the math because there's not a single research report out on this company. It's probably the first time, I think, in Canadian history where a company finances itself, gets up and running, and not one Bay Street analyst ever covered it. So we've done the math. We've checked it out. And look, they're going to make $1 million U.S. cash flow per week. So you do the math, $50 million a year.
Yeah.
And that's U.S. dollars, and the enterprise value is 180 Canadian.
Well, that's a great example for people to know how you go about it at BT Global. And if people want more information, go to btglobal.ca, btglobal.ca. Paul, really, thanks so much. I always love it when you take time and join us and share your expertise. Great stuff.
Thanks very much, Mike.